STI index reaches record high. If you see a title over here, it crosses 4,000 points for the first time. Before I review to you 7 names that are very interesting, I'd like to show you something interesting to start things with. The first is that STI, as of year to date, is outperforming S&P 500. I know many younger generation investors are writing off STI too quickly, fully investing into US equities, and we can see over here that STI has outperformed by a little bit, correct? The pink line being S&P 500. But what do we need to take note of also is that I've marked a cross over there to symbolize the real return of S&P 500 in Sing dollars, because we have to always adjust for US assets for US dollar depreciation, correct? So the real return year to date for US S&P 500 is around 7.5%, and you realize that it's massively underperforming STI index. Maybe this is just a period only. Over a long period, maybe S&P 500 will outperform. We never know. But as of now, to say that S&P 500 will always beat STI, that can be refuted simply by this chart over here. The next graph I'd like to show you is also telling a very interesting story. Green line again is STI index. And I've plotted it against DBS, which is the turquoise line, OCBC, which is the pink line, and UOB, which is the purple line. These are 3 big banks, correct? And very popular among Singapore investors. What can we observe? All 3 banks are underperforming STI index on a year-to-date performance, correct? And we have long associated banks to outperform STI for longest period. And for this specific moment, STI is outperforming and it's not even close because OCBC and UOB are negative on a year-to-date. So what exactly is driving this phenomenon? The reason is because this rally, unlike the previous ones, are much more broad-based. There are many STI components delivering outperformance, including ST Engineering, and there's a major recovery in the small to mid-cap space, and that's what I'll be highlighting to you today. Hi guys, welcome back. Thank you for sticking with the long intro. Let me give you a flavor of what you're going to expect for this tutorial. I'll be sharing with you 7 names that are doing double or even triple digit gains over the last 1 year. You've heard it right, triple digit gains. And again, these are not penny stocks. Many of them are very suitable for dividend investors and have a very good long-term track record. Without keeping the suspense further, let me review the first name to you, which you may have heard before. It's none other than UOB Kay Hian. UOB Kay Hian has done 58% over the last 1 year. Wow, that's a very good appreciation, correct? Way bigger than UOB. And the main part is this. The P ratio for UOB Kay Hian is only at 8.76. Dividend yield 5.56%. And if you measure this against UOB, it is arguable that UOB Kay Hian, which is stock brokerage business, is even better than the bank business. Of course, the flip side is that we can argue that banks, they have an oligopoly, whereas for stock brokerages, it is a bloodbath of competition. I understand it. And if we see over here, the profit and revenue growth has not been as strong as what we see in UOB. Nonetheless, over the last few years, UOB Kay Hian has grown, correct, in terms of net income. And my guess of one of the reasons is its strong partnership with Endowus. Endowus is Singapore's leading robo-advisor. And if you have an account with Endowus, you realize that it's parked under UOB Kay Hian as the custodian. How much profits does UOB Kay Hian earn from this relationship? If I'm not wrong, it's not fully transparent and it's B2B, but I think it's logical to guess that as Endowus grows, UOB Kay Hian stands to benefit. Second name on today's list, Sheng Siong. Sheng Siong has grown 33% over the last 1 year, and right now it's itching to crack this $2 mark. Personally, I have a small stake in Sheng Siong already, and I'd like to share with you that Sheng Siong is actually a very resilient business that I've covered before on the channel. Simple reason, pandemic, we buy more toilet paper. Recession, we buy more Maggi Mee. In any case, rain or shine, Sheng Siong would make money. Sheng Siong has also steadily grown its dividends, and because price has appreciated, dividend yield is only at 3.2%. So before you go buying into Sheng Siong shares, let me explain to you also if it's expensive or not, and I have 2 sides to the coin. I'll measure Sheng Siong against its historical price-earnings ratio. Sheng Siong's business has been roughly the same over the last 5 years. So I think this approach is very reasonable. What I'm plotting over here is to show you Sheng Siong's historical price-earnings ratio. Let's discount away 2020 where it's pandemic and the share price shot up before profits were registered into the books. That's why price earnings ratio skyrocketed 28 times. Never mind that, we focused and realized that Sheng Siong usually trades at a band of 16 to 19 times price earnings ratio. Judging from this angle, it is arguable that Sheng Siong right now is expensive, simply because it's now touching the higher side of the band, correct? That point of view is valid. But there's also another side to the story, which is on the top. There is a comparison between its 20 times price earnings ratio right now against sector average. Sector average means its peers in the supermarket business or in the FMCG business. The average is 26 times. And by that point of view, it is arguable that Sheng Siong, showing very consistent growth, is actually cheap. Let me know in the comment sections what you think. Again, in investing, there's no right or no wrong. Let's move on to the third name for today, which is someone that's grown 62% on a 1-year basis. You may have seen their trucks before on the road, and this company is none other than Pan United Corp. Pan United is another one that has been paying steady dividends and a price earnings ratio of 14 times with dividend yield of 3.4%. Its business is in concrete mixing, and previously they have owned pots before. But purely on the concrete business, they have a 40% market share on ready-mix concrete, which is what is needed when we do big infrastructure projects like Jewel, like building of ports, etc, etc. So as long as Singapore is investing in the infrastructure, Pan United stands to benefit. Coming to here already, if you have learned something, help me smash the like button. It's taken our team hours to prepare this presentation for you. And I really want to give some light to today's title, which is, if you're buying just banks alone, you may be missing out. It's true. All of these 7 names which I'll cover with you today are things I've covered on this channel, and they are showing spectacular growth right now as more spotlight is shown on Singapore's small and mid-cap stocks. Hopefully you learned something. Thank you very much again for smashing a like. And let's move on to the 4th name for today, which I have a small personal story on. This company is none other than Food Empire. Food Empire has delivered 87% on a 1-year basis and is at an all-time high. It just cracked this 1 billion market cap, as you can see at the bottom, with a P ratio of 14 times and a dividend yield of 3.3%. The story I have with Food Empire, it is an outstanding business that I researched before, and that's why I bought a small stake in it. But as you can see in this screenshot, I cut losses on February 2022 when Russia invaded Ukraine. I understand that Food Empire has vital plants in Ukraine, and that's why when I couldn't see light at the end of the tunnel, I decided to cut loss because it was hard for me to quantify what kind of damage it could have to Food Empire. As you can see over here, that was a smart decision because Food Empire shares dropped by a further 27%, all the way as the war got deeper and deeper. This proved to still be a good decision for the next 6 months and even for the next 9 months. But what happened? I moved on to something else, and Food Empire did a fantastic turnaround. In this span of time, they have more than tripled in terms of share price and left me behind at the altar. So as always, there are regrets in the investment journey, correct? And rather than being salty, I'd like to congratulate Food Empire for providing its shareholders continued growth in profits as well as dividends. Sales numbers are up and things are looking good. The 5th company I have for you today is something I've covered extensively and made big profits from, but also left some on the table. If you follow this channel, you know that I've mentioned fondly of LHN. LHN is the first company that's done triple-digit gains in the last 1 year, clocking 118%. I made a healthy 5-figure from LHN, but I've also exited at the 50+ cent level. And kudos to it because right now, even DBS is highlighting that it's worth probably way more at a target price of 81 cents. This is if they successfully list their Collywood, which is their co-living business, quite likely via a REIT. If you bought LHN while watching some of the videos I cover on it, and still holding on, congrats, I think you have easily clocked a bagger, correct? And there are always tips I leave on my Telegram group. Take note again, on Telegram there are a lot of scam channels. This is my official one. Look for links below for it. And if you like to trade Singapore stocks, of which many are at all-time high right now, look for links below to sign up with MOOMOO today. They are one of the best brokerages with a fantastic interface that you can use on your mobile. So if you're new, check out my links. I have a special referral reward worth $820 just for you. With that cleared, let's move on to the 6th name for today, which is also someone that I've bought, made a substantial gain, more than a bagger, but left some on the table. This company is Centurion Corp. I've even made multi-baggers for private clients also. but together with all cashed in, and continue to see Centurion climb and climb. Right now, it's clocked 194% on a 1-year basis. Wow, that is a 3-bagger already, and climbing server. So if you still have Centurion shares, congrats to you. And Centurion was my second highest pick in this previous video, how to invest $100,000. I'll leave links for you to follow behind, and press on subscribe because I'll be releasing a new video, how I'm investing $100,000 in 2025. If you don't want to miss out on that episode coming up soon, remember to subscribe and press on the notification. While I no longer have Centurion shares, I still have shares of this company. This company is also owning some real estate. While it's not a triple-digit gain, this company has also rewarded me massively with a 39% gain in the last 1 year. With the appreciation, Bowsti is my 5th biggest holding right now in my entire portfolio. And in my opinion, it's arguably still undervalued. Bowsti's market cap is 740 million with a price earnings ratio of only 7.36 times. Dividend yield 3.82%, but that's not including the 2 cents special dividend that is given out to shareholders very recently. So why do I say Bowsti is arguably still undervalued? The first is that it's been able to monetize some of its real estate through joint ventures, and this is one with Unified Industrial. Bowsti has been able to unlock profits from its real estate by these joint ventures, and what they'll do is they make money through asset under management. These seem good, but the best part about Bowsti is not even this segment. Real estate is always lumpy, but there's one segment of Bowsti that is strong and steady and is growing at 20% per annum. If you have followed my previous tutorials covering Bowsti, you realize that I've mentioned favorably on its ESRI technology distribution on its geospatial segment. Long story short, they have exclusive rights to distribute this geospatial technology, which is from ESRI, and this technology can be widely used across oil and gas, engineering, and even in urbanization planning. When oil price rose, naturally there are more contracts to survey for potential oil fields. Currently, the geospatial segment for Bowsti is almost half of its profits. And if it's growing at 15 to 20% on a yearly basis, I would argue that it's possible that that segment, based on a price earnings valuation of 20 times, is easily worth $1 billion already. Pulling back Bowsti's chart, we realize that market cap right now is only at $740 million. Geospatial, in my opinion, is worth $1 billion, which means all the real estate profits are just going to bump this up, and that's why I see Bowsti as a potential multi-bagger. Let me know if you agree or not, and as always, thank you for watching right at the very end. I'd like to introduce you to some of my previous tutorials. The first is this, which covers blue chips propelling STI to its all-time high. Today, we cover on 7 small mid-cap stocks. This covers some blue chips, and I think it will interest you further. With that, for me, see you there. Take care as always. Goodbye.